Welcome back to Total Money Management. We've got a special for you today. We're going to be mastering the market cycle.
Bingo.
Yeah, and if you haven't read it yet, have a read of Howard Marks' book.
Yeah, and if you don't want to read the bloody book because you're lazy, write to us and we'll send you the white paper.
Yeah.
Well, you made a comment on the last podcast saying you could teach people how to invest on one chart.
On a post-it note. I think
Absolutely. Absolutely.
Yeah.
Post-it note might be a stretch, but I could probably manage it.
Yeah, just buy at the bottom and sell at the top.
Yep, that's
just
it.
keep doing that.
Bloody easy.
It's done.
Easy.
All right. See you, folks.
Yep, see you next week. That was the last one. This is actually the last podcast from Paddington.
Mm-hmm.
Yeah.
Cheers, gents. It's been a journey.
Yes, gentlemen.
And thanks for everyone that's listened.
Yep,
We'll
you're a bunch of gems.
Yes.
It's going to rely on our tech prowess to get these episodes into the ether.
We've got no Dan anymore. Dan's actually outside.
I know. Who's going to name them?
We've locked him out. That's it.
Who's going to name the episodes?
We'll have to do that ourselves.
Oh, no.
I've got some AI that could probably...
Jacob, you are funny.
He's like an AI addiction. Righto, let's get on with that. Righto, what do we got? I'm sure people are chafing at the bit to master the market.
Yeah.
So
Well, we're starting off with some bold text.
bold text.
Cycles or patterns arise naturally, but in the stock markets, they arise from investor behavior. People are patterns.
Bingo. There you go. Now, but in all seriousness, the superior investor is mature, rational, analytical, objective, and unemotional, right? Now, Warren Buffett said, if you can't manage your emotions, you can't manage your money, right? And so the thing I like to point out to people is that it's, like we said, I think last week, right? Charlie Munger said, well, if economics is not behavioural, well, what the hell is it? And what I mean by that is when they talk about the stock market, right? You think about it, you go, oh yeah, the market. But if you go, okay, well, what's the market? Oh, it's just a group of people. Oh, okay, so it's actually just a bunch of people. Do you know what I mean? It gives you a different context because then you go, well, that's when, the market doesn't resonate with you, right? But when you talk about people and psychology and behaviour, you go, oh, right. Right, so you're thinking happy, sad, bullish, bearish and all that stuff. But when you go the market, it's like this sort of objectified thing with no sort of emotions attached.
Well, I know some people have been thinking this, and I am as well. So most of Wall Street now is actually controlled by computers and data sets.
Yeah, algorithms and stuff. Yeah.
But my argument to that is, well, we built them.
That's exactly right. Right, the algo only works as good as the input on the data and stuff. So I just think that's really important point to get first up is what you are dealing with is not a market. You are dealing with other people, right? And other people who are emotional. They have different risk attitudes. They've got career risk, as professional investors. Like there's a whole raft of things, right? But it's essentially saying you're in a relationship with someone who's going to buy your stock or sell your stock, right? That sort of stuff.
On the psychology piece, if you can't manage your emotions or your psychology, then you shouldn't be managing investments. My argument is 9 times out of 10 people think that they can, but they can't, and that self-realization never actually occurs where you're like, actually, I'm a bit useless.
Yes,
You're always like, oh, well, I'm great, and I'm listening to Tom and Steve and Jacob, and those blokes are smart. But in reality, when it boils down to it, you don't actually make that decision intrinsically because you trust yourself.
Yeah.
And your ego.
Well, part of it is too, everyone's pretty good when the market goes up, right? As I sort of prone to saying, I don't get that many calls when the market's going up, but I get a fair few when it's going down, right? And that's the psychology coming in, right? I can say to people, and I think it was the last episode, like you just said before, I could teach people with one chart, right? But the big thing, it's obvious, right? You look at 100 years of data, I can teach it to you really easily. I can't teach you emotional maturity.
No.
Yeah.
Right? That's the difference. Because it could go up and people would say, oh, I know Steve said that, I should be rebalancing, but I don't know. I think he's wrong. I think it's going to go further because I've talked to Bob and Jenny and Bill and Donna and, that guy down the road, and he's really clever, blah, blah, blah. And that's what happens, right?
But that's why you take the emotion out of it and you have a framework.
Tom? Exactly.
And you have to completely internalize the fact that you can't control the outcome, like we spoke on the last episode.
Yep.
And unfortunately, it's not until you've gone through a bunch of really bad down days and a bunch of really good up days until you can really kind of desensitize to it.
Yeah.
It's taken me a long time to go to a point where I can look at my app and go, oh, wish I didn't look at that.
Yeah.
But it doesn't
not
spiral me. And
Yeah, absolutely. I think that's the number one point is when you can open a portfolio and go, cool, whatever happens. But like you say, it takes a while. And that's why I say to people who do our courses, my job is to get you to feel what it's like to lose money, but not actually lose money.
In a controlled environment.
Right? Because what I'm doing is saying to people, like, we say, focus on not losing money, right? But there's no the emotions are the thing that drives you. And you only get that emotion when you lose money, right? Otherwise, you don't really, it doesn't rest. Oh, yeah, Steve's always talking about don't losing money. I'm doing fine, right? Market's going up and everybody's loving it and they're saying Steve's wrong. And, it's only when you lose money you get an emotional fix, right? And it's the same on the upside, right? You get, like you said before, you get overconfident and it's like, hey, I'm really good at this, right? You don't really know what you're doing. Right, but you think you know what you're doing, right? And because you're getting an emotional feedback going, you're such a smart person, blah, 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 blah. I knew what I was doing, rah, rah, rah. And then you get the other side, right? And that's why we talk about the numbers so much, because the numbers are the ones that go, dude, you're the greatest investor in the world, but the Cape's at 42, right? Like, stop thinking you're going to outbeat everybody.
It's interesting. Fear of missing out, it works much more potently when on the upside. But you could look at me losing 50%, for example, on social media, whatever else, and you go, oh, what a dickhead. It doesn't matter.
Yeah.
But if I posted I've just made 300%, you'd be like, oh, I need to do.
Yeah.
What stock is it? I need to buy.
Yeah. Absolutely. Is it too late to get in?
Yeah.
So, yeah, it really is. It's the pinnacle point. Because once that Buffett quote is so true. Because if you invest emotionally, you're not going to make money.
Yeah.
Right? It is just not going to work out. It might work out once or twice, and then that just means that you were lucky.
Yeah.
Right? All skilled investors, all skilled professional gamblers, right? Zero emotion, absolute understanding about probabilities. Right? They know that there'll be bad luck where they just, they've got a sure thing and it falls over and, they lose a lot of money. They get all that stuff, right? Because they understand the statistics behind it and the win-loss ratio and all that sort of stuff.
Yeah,
right?
and they don't blow their accounts up.
Absolutely, Tom. Absolutely. Rule number one, right? You got to survive.
Yeah, you got to make sure you've always got cash. But when you're looking at cycles over time, price charts, it's quite difficult. Let's use Cape, for example.
Yep.
So Cape over time could be 5, could be 42. There's periods of time where your odds or probabilities increase or decrease throughout that 30, 40, 50-year cycle.
Yep.
So you're looking at Cape now at 42, and we talk about this a lot, so we're kind of labouring the point. The odds of the next 10 years doing the same thing is very low. But if it was 12 or 8 or 6... then it flips.
We'd be telling people to pile in.
Exactly.
Absolutely. That's what I mean. You've got to be unemotional about it and say, here's the numbers. What are my chances? It's like we talk about when we talk about the risk hierarchy, right? If you invest in ETFs, you mightn't be that good, but you'll probably do all right. If you think you're a stock picker like Warren Buffett, best of luck, you're going to lose, right? And the statistics show that the winners, the people who beat the market are minuscule from picking stocks, right? And again, you look at the statistics and go, hey, Tom, sure, you could be a great stock picker. You'd be amongst the 0.03%, right? What do you think?
But fooled by randomness has an answer for that as well. You're going to get people that somehow
Yeah,
manage
absolutely.
to pull that streak off.
Yeah.
But the probability is not there.
Yeah, that's right.
Like he
Well,
uses
if
a
you've got
pretty-
10,000 fund managers, well, one of them's going to be a standout, right? That's but it's true, Tom. Yeah, you will get a winner. And I think, as Buffett said, those winners will write books.
Yeah.
Hey, here's how you beat the market, right? Because they did it.
They don't understand the role randomness played.
Absolutely. And it's the
like-
same with property, right? There's heaps of people writing property books or selling property courses of, I did it, you can do it too. And it's like, no, because it's not 2000 when property was really cheap, right? It's now 2025 and properties are really expensive. So again, it's like me preaching that, hey, we know how to invest and you can do it too. You should pile in and go, oh yeah, the Cape's at 42. Well, best of luck on that front, right?
Yeah, you have to assess the information in front of you. And I guess that goes to the point of you can't pick the end or the beginning of a cycle. You never really know when that's going to be. You can only look at it holistically and say, well, the probabilities at these two endpoints are probably not somewhere you want to invest or somewhere you do want to invest.
Yeah.
So it's difficult, especially for people that I know a lot of people listen to us that are wanting to start investing, and they're doing the right thing by probably taking a more contrarian approach to start with. I wish I did. But then you still have this feeling of, I just want to get in.
Yeah, absolutely. It's well, I'm saying during the week, right? It's like you learn the guitar. Doing our courses, this is, the difference I think we do is when we teach people, what we're doing is not urging them to get in straight away and carry on, right? I always say to people, start with a little amount of money, right? Get used to it emotionally, right? And then you sort of go, okay, I've had down days before, right? That way you get emotionally used to it, and you've got a corporate memory, right? Of saying, oh yeah, I remember those big down. Oh, yeah, that was awful, right? Liberation Week was one of those, right? And so that's really, really important. But what I was saying before to someone this week, Jacob, it's like learning guitar, right? It's like I can teach you the guitar and they go, okay, now put it down for 12 months, right? And it's like, but dude, I just learned, I got to apply this, right? And it's like, no, now's not the time, right? Or, I want you to start small. And it's like, no, I'm going to go and buy a really expensive guitar and play straight away, right? Yeah, I know all that stuff about Cape, mate, but, you've convinced me that I should be in the market, right? It's that sort of stuff, right? Yeah. And it's how we think over time, right? Because a lot of these people, I think you see on Twitter coaching about property and stocks will disappear when the market crashes, right?
Yeah.
They'll go off into the ether.
Or that, like any good salesperson, they'll find a different angle and talk about how it's all you're going to be okay.
Yeah.
This is a new thing you should now do.
Yeah, that's true. That's true.
So how does one recognize where they are in the cycle?
Just use Cape. And there's two things. One is Cape, and the Cape is a dry number, right? So we've just talked about investor psychology, and that's why we, 18 months ago, you guys were saying if we talk about technical analysis, it reflects investor psychology.
Yes.
Right? So you can use TA and Cape together. Right? So market's expensive, but you can say, yeah, but Steve, we're still above the 200-day moving average. It's like, okay, cool.
Yeah, momentum's still on our side.
Absolutely, Tom. And then you guys can say, Steve, now it's hit the 200 on the way down. If the Cape was at 10, you'd be going, hey, don't worry about it, right? Because you've got a long runway. But when the Cape's at 42, you're going, this might be a good idea to rebalance my portfolio substantially.
Well, that's why, I personally like moving averages because it gives me an unemotional point to change my asset allocation. So
and they're really simple.
Yeah.
Right?
And you never miss the swing up because it's going to cross back up if it's going to have a run anyway.
Yeah.
Again, it's this risk, right, with any of that stuff is people worry about, well, what if it turns and goes? And it's like, well, you won't.
I think a lot of the problem is, Tom, not just with TA, but just generally is people want to get perfect, right? They want to get the bottom. And it's like, you don't have to get the bottom. right? The bottom was in March 2009, March 9, 2009, right? I bought an absolute bucket load of stocks in April. Well, I still did really fine, thanks very much.
Yeah.
Right? Do you know what I mean? Like, and then you get but what if it goes down further? And my argument is, hang on, dude, you're already getting 9%. Now, if it goes down further and I come back to you and go, hey, Tom, now I'll offer you 12, you wouldn't be going, this is terrible. You'd be going, cool, I'm going to get more.
Yeah. Well, the reality is you could have bought at any point over that 12-month period from March 9 to the next March 9.
Oh, absolutely.
And the year would have done fine. And
absolutely.
The Cape would have been 8 or whatever it was at the time.
Yep.
And it could have been 12 by the time you bought it.
Yeah.
But that's where rebalancing and asset allocation come in.
Yes.
Because it's not like you'd go all in. You'd just play with your weighting.
Yeah.
And you'd, agree on a time frame, and maybe every 3 months.
Yep.
If you decide you go 80% or 90, whatever it is.
Yeah.
That you're still going to have a pile of cash there to buy a bit more as it falls.
Yeah.
Right.
If there's if you look at history, one of the things I remember was they said you generally get 2 bites at the start of a bull market. So you get a bull market to start, it goes for about 12 months, then it drops and you can get in after that, right? And it makes sense because you think what happens is bull markets usually start, unsteadily. Then they go up and people don't trust the first.
Yeah, the disbelief.
Yeah, it's a bit like, this won't last. Things are still awful. And that's when you get a trigger. Everybody panics and sells down. And then it stabilises and goes back up again.
It breaks the previous high.
That's right, yeah. And people go, actually, the economy's actually all right. And then they all get back in again, right? And that's when you get that secular upturn. Yeah. But, that's... It's a lot of it, a lot of it's the psychological stuff because you look at the market cycles charts and it's blindingly bloody obvious.
Yeah.
Right?
But the problem is because we have all this information flying at us that will tell you it's all fine, it's different this time, it messes with your perception. Like you can look at the chart in isolation and go, okay, yeah, that makes sense. And then you can look at previous history and see how markets have followed that pattern.
Absolutely.
But when you're in it,
yep.
you're like,
yep.
But maybe we're just halfway up.
This time's different.
Think about
right?
it. Maybe we haven't completed the cycle yet.
Especially when you throw rubbish out like Japan went to 100 and the Japan Cape went to 100. You're like, well, we're still at 42.
Yeah, we're not even close. Now, there's one thing I want to have. Chapter 9, right? Superior investing. Oops, what's happened there? Superior investing doesn't come from buying high quality assets, but from buying when the deal is good. The price is low, the potential return is substantial, and the risk is limited. Okay? So that's where we talk about the earnings yield and stuff, right? That's where you've got to ignore the squiggly line that they talk about daily.
Yes.
Right? And say, okay, what's the earnings yield? i.e., is it a good deal? Yes, good. I'll buy some. Right? Because what we know is at market lows, everybody's completely freaked out because of what we talked about with the recency bias. Oh, stock market's really dangerous, dude. Why? Oh, it's gone down 30%. But if you say to people, oh, God, I was getting 6%, now I'm getting 10. People go, well, that's fantastic. And if you go, it's a stock market, people go, oh, that's terrible.
Yeah, I mean, but with most people buying into ETFs now, most retail people at least anyway, buying into ETFs, you've got yields that you look at that aren't, you've got the US yield, you've got the Australian yield, emerging markets and things like that. So it becomes a little bit more difficult to understand what the yield actually is.
What do you mean though?
Because you can, let's just say you're in the 70s or 80s and you're looking at a stock.
Yep.
And you can look at 10 different stocks and you live in America and you can look at their yields. Whereas with an ETF, because it's so pegged into America.
The correlation.
You can't look, you might look at emerging markets and go, well, the yield's 6 or 7 or 10 or whatever it is. The Cape's really low.
Yep.
But then there's this big hairy risk over in America.
Yeah, you can still get bushwhacked sort of thing.
You can still get smashed.
Yeah,
well, anything could get bushwhacked.
Yeah.
So
the way the US is going.
So you then ask yourself, at what stage are we actually in? Do we wait?
Now, I'm glad you brought that up because chapter 9, a couple of things. Investor rationality is the exception, not the rule, right? So again, what we were talking about before outside, right? The theory says investors are rational. Well, we know clearly that's wrong, right? People are not rational, right? But just quickly, right? The 3 stages of a bull market. The first stage where only a few unusually perceptive people believe things will get better. The second stage, when most investors realise the improvements are actually taking place. And the third stage, when people conclude things will get better forever. And then Howard Marks says, what the wise man does in the beginning, the fool does in the end, right? And this is why we say the people who are getting into stocks now are going to be probably disappointed.
Well, they're going to get smoked.
Right? Yeah, because these are the ones who say, these are the people who... And again, what happens is you get this stage where the most risk-averse people get in at the top generally because they go, it's now safe.
It's safe now, yeah.
Right? Everybody's making money in property. Now is the time to buy, right? And that's exactly the wrong time to buy.
Yeah, it's the last zebra going to the lake when the crocodile comes out.
Yeah, absolutely. Absolutely. Now, more importantly, we should just deal with this. 3 stages of a bear market, right? The first stage, just when a few thoughtful investors recognise that despite the prevailing bullishness, things won't always be so rosy. I think we qualify there. The second stage, when most investors recognise that things are deteriorating, I don't think we're there yet. And then lastly, the third stage, where everybody's convinced that things can only get worse, right? We're definitely not there yet.
The opposite.
That's usually before it turns again.
Yeah. But again, see, that's Howard, right? Howard Marks, right? You look at all that stuff. It's all about the emotional thing, right? When people think it's going to get better. No. They don't think it's going to get better. They feel it's going to get better. Right? Let's be honest. You're not sitting in there in the suburbs reading the economic data weekly going, oh, employment's tracking well. Oh, that's excellent. House prices are moving. Oh, that's good. Fine. What's the producer's price index? Oh, look, it's gone up another 3%. Oh, that's excellent. We should get into the market. Right? People looking and going, everybody's talking about stocks. Yeah, well, we should get into stocks. Right? It's a feeling stuff. Right? And so that's where I think it's really important because that's where you get this sort of complete disconnect like we've been talking about for 12 months where people are just going nuts.
Yeah, but
right?
to my point earlier, like the American market is where it is and we're very, very convinced that we're in the third stage of the US market being.
Yeah.
But then you have things.
Well, we are.
Yeah. But then you have things like emerging markets that are probably in stage 2 or 3 of, or were in stage 2 or 3 of the bear market. Where people are like, well, why do you invest over there? It's crap.
Yeah.
You need to be in tech. Come on, like, what are you doing?
Yeah,
and then,
absolutely.
And then the money transfers through.
Yep.
And that's the point I was trying to make before, like because it's opposing points.
Yes,
so
yes.
You get in over here based on Marx's amazing book, and then America craps its pants, and you lose money anyway.
Well, that's why you remember if the US sneezes,
everyone catches a cold.
Yeah,
and that's the overarching theme.
Yeah, I think the point I'm trying to make is its value. Like, it doesn't matter if it gets lower over there because it's value.
Yes, yeah.
Yeah, you might be buying $1 for 40 cents and it might go to 10 cents.
Yeah.
That's what makes it.
One of the things with CAPE is, what you notice with CAPE is the cheap countries like, I think Turkey. Is it Turkey or Brazil? I get it confused, but I think Turkey's about CAPE of 10 or something, right? Like, it's really cheap, right? So Turkey may get hit if the US market declines, but what the studies have shown is if it's cheap on a CAPE basis, yes, it may get cheaper, but it'll still do better over the long run, right? So, and the reason why it's cheap is because there's not many people there anyway in that market, right?
Well, companies.
Well, yeah, but what I'm saying, Jacob, is Turkey's cheap. And like Tom said, you can look at it and go, man, that's cheap. But what you can do is say, yeah, but if the US falls, Turkey will go from an already cheap 10 to a really seriously cheap 5, right? But that's 50%.
I'm instantly thinking of that Russian oil company that was
Luke
the bane
what?
of your no, was it Gazprom?
Oh, Gazprom, yeah.
And you're like, man, I got this thing so cheap, and it got cheaper.
And I just kept buying more and more of it.
Yeah,
It got, it's like PE at 2.
I did the same with Lukoil, and then all of a sudden we can't do shit with them.
Yeah. Well, I must admit I did all right out of Gazprom, but yeah, I've still got them in an interactive brokers account actually.
Just wait until it opens again.
Yeah, no, they what do they call it? They sort of cordoned them off. Like they created a separate account for you and said, okay, we'll put these ones in here until we figure out, what's going on.
Yeah, well, just on a side note, Colombia's got a cape of around 6.
Right. Okay. Yeah. So, but I don't think there's a Colombian ETF. Maybe we should buy a lot of cocaine.
Yeah.
Oh, sorry. What was I thinking?
We didn't swear, but we have explicit references.
Not advice. Now, chapter 15, right? Remember when there's nothing clever to do, i.e. now, the mistake lies in trying to be clever, right? And also chapter 16, in investing, success teaches people that making money is easy and that they don't have to worry about risk, right? And they're really pertinent at the moment because, like I say, you don't really learn anything until you lose money. And the smart people who lose money at the start then go, okay, I need to think about this, right? I need to learn. I need to go and find someone to tell me what to do and, how it works, read books or something like that, right? The dumb ones are the ones who lose money and then say it's all a casino and, they toddle off and do something else.
Or worse, double down.
Yeah. Yep. But, we've all done that, mate.
We're all
Please,
dumb, really.
Stop it. You're bringing back bad memories. You're bringing back nightmares for me.
Chapter 17 is interesting. The tendency of people to go to excess will never end, and thus, since those excesses eventually have to correct, neither will have the occurrence of cycles, and that means that investors with the ability to understand cycles will find opportunities to profit.
Yep.
So it wraps it up quite succinctly.
But those investors will also get called broken clocks.
Yeah.
What's that? Well, yes and no, Tom. I think you're right. But I think also too, as Howard Marks said here, there's one part here where he says, it's not what you buy that determines your results. It's what you pay for it. Right? And again, Talib is like that. Options are like that. Like you can lose money on options slowly and then go bang, right? George Soros was like that. Soros was sort of like, I don't mind losing money. And then when he saw something that was a no-brainer, he'd go in big, right? And that's where you've got to have the ability.
Kelly.
Well, you've got to have the ability, like Kelly, to say, okay, I know how these returns are distributed. I know how I should invest. And when I get a really good opportunity, i.e. Buffett's fat pitch, right? I swing for the fences, right? That's the way you make money. You can be wrong 7 other times, but on the 8th time, if you absolutely murder it, bingo.
Fine, yeah.
Right?
Well,
it's not easy to do. But it is doable.
Well, it's emotionally not easy, right? And there's the probabilities. If you make money 51% of the time, you can be wrong the other 49%, and you make over the long term you do all right.
Yeah, but the trick there, Jacob, is if you invest the same amount of money all the time. So if you do 10 grand, 10 grand, 10 grand, yes, you can be right 51% of the time. But if you go, this looks really doubtful, 10 grand. This looks unbelievable. 100 grand, right? Bingo, right? And so that's where again, and it's like Cape, right? If it's at 5 or 10, well, gee, the odds are really in your favour that you're going to make a lot of money according to history, right? If it's at 42, okay, well, maybe. But you look at it and, no professional gambler would look at the odds at the moment and go, hey, yeah, this is cool, I'm in.
Yeah.
Right? Because you look at it and go, oh, what's happened every time it's 42? It's like, oh, it's been a disaster for 10 years. It's like, okay, so you want me to, invest into that, right? So that's why I think it's really, really important.
i.e. every super fund in Australia.
Yeah. But again, this is why we talk about it, because their investment mandate is to stay invested, right? But they also believe that, like, oh, well, you're young. It doesn't matter if you lose money, just keep buying stocks, which is, that to me is just nuts.
Yeah.
Right? We go through our lives looking at price. What's the price, right? These guys are saying, no, don't worry about the price, just keep buying it. It's like, yeah, but what if it's twice the price? No, it doesn't matter, mate, just keep buying it. I mean, that's why I say one chart. I can teach people in one chart by showing them all that sort of stuff where they look at it and go, yeah, okay, it makes sense. The trick is getting it emotionally, right? And that's where it takes time. And, like we coach people through that, right? Where they go, oh, okay, now I get it.
Yeah.
Right?
The repetitions on your psychology is why you make or break.
Yeah. It's easy to learn something logically, right? It's really difficult to get it emotionally, right? That's why you become unemotional, and that's why Howard says, investors are emotionally mature. What did he say there? Investors are
superior investors, mature, rational, analytical, objective, and unemotional.
Yeah. See, do you know what I mean? You've got the information, you know how it works. All you got to do is override those emotional responses.
But I think the important part, which we didn't talk about, was the superior investor who resists external influences, remains emotionally balanced, acts rationally, perceives both positive and negative events. That's important. Most people look at positive only.
Well, that's what Tom was saying before, right? Up days, down days, like,
yeah. Where are we? Weighs events objectively, analyzes them dispassionately, and importantly, separately, like looking at both of them and going, what's right and wrong on both sides. But the truth is that sometimes the euphoria and optimism causes most investors to view things more positively than warranted, which is what we've just talked about. So people need to look at terms of events and go, well, what happens if it's good or bad on both sides of the bench?
Yeah.
But the trick to short-circuiting all that stuff is to have a system that takes the emotions out of it.
Yes.
Because if I didn't have that, I'd be screwed.
Absolutely.
Like when I was investing based on gut, hopeless.
Yeah.
But if I have rules that go, when it does this, I do this.
But
okay.
But the rules on that, Tom, that's why what we teach I think is really important, because what I'm doing is saying to people, you got to have the knowledge to be able to say, yeah, Steve told me this had happened.
Yeah, if you got no knowledge and no emotions,
you can have a system and it just doesn't work.
I've got a roulette and go all in.
Yeah. No. So that's why, as I say, if you get that, where you get the knowledge, you meditate on it, right? It's like, okay. You ask yourself questions. Oh, well, has the Cape ever been really high and people have made lots of money? No. Okay, all right. Well, that's a good point. Yep. And then when you do that lived experience stuff, right? I mean, old people like me, all I've got 40 years of history of economics, right? So I know more than you guys because I'm older.
But you've also been paying attention for a long time.
Yeah, but that's what I mean. Like, I've been through the emotional roller coaster. That's why I can say to you, losing lots of money is like really awful. And that's when you go, okay, I'm not doing that again. Right. And why did I do it? Oh, I did it because I got really greedy and I refused to rebalance. Right. And that's where you go, next time that ain't going to happen. Right. Why? Because you hand on the stovetop, right?
Been through the ringer. Yeah.
And that's what I mean. That's when you then, you shrug, right? Up day. Oh yeah. Down day. Yeah. Why? Because you've been watching it for 25 years and it goes up and it goes down, and you get volatility clusters and, the Cape's really high, be careful, Cape's really low. Oh, well, there'll be a Cape come when it's really low. Yep, cool, good, right, okay, that's the way the market works, blah, blah, blah.
I am worried, not to turn it political, I know we're wrapping up in a sec, but if we end up in something like the 1920s, for example, I don't know if the
late 20s, you mean?
Yeah. No, the 1920s.
Yeah.
Where in the Depression, where
1929.
Yeah. Where I don't know if the world's equipped for something like that, because right now everything's euphoric and everyone's amazing, and it still feels like the globe is like going to hell in a handbasket.
Absolutely.
What about if we get a Cape of 5 and there's 50% unemployment?
You don't want to think about it.
Well, that's what I mean. Like, I don't know.
Don't think about it.
Listen, it's valid, right? Because I did it today. I think we're looking like more like 65, right? 65 to 82, right? We had the Vietnam War. Now we got the Iran War, right? Oil exploded. Now we got oil exploding, right? The Middle East is in trouble. We're getting inflation. We got inflation. This is why we talked last week about Friedman's, the storm before the calm.
Yeah.
Right. And what is that? That's a cycle, right? We've got the transgender woke people, and we've got the right wing people, right? And you can see Pauline Hanson is rising, right? So all of that is, again, look at it, go, hang on, as an old guy, I can look at it and go, hang on a second, I remember when this last happened. So you're right there, and that's the thing, people don't think in cycles, right? And so when you do, that's when you go, hang on, I've been here before, and that's when you get more unemotional. I think I'll just move a bit more into cash, right? And that's the process of doing that.
I just don't think we've got the mental strength to deal with that stuff anymore.
Well, I think we have, but I think the thing that concerns me is it's going to be messy. And I mean really, really messy, right? Because, again, I looked at it, America had civil war through the 60s with the Vietnam stuff, right? We had raging inflation. The 70s, and I think I've said this before, in America, if you watch the TV shows with New York, because I was looking at it today, it was all about crime and violence, right? Because prices were so expensive, people couldn't afford stuff, right? So they just robbed stuff. So if you look at New York now with Mamdani there, what you're seeing is heaps of immigrants on the street selling stuff, right? Cheap Chinese goods and stuff, and people are complaining, right? And you look at that and go, this just looks like the 70s, right? The streets are becoming untidy, the infrastructure's running down. So you've got a societal breakdown. But Friedman's argument is, this is the transition, and they'll wash through and they'll work it out. And like we've been talking about it, you've got to be sort of unemotional and say, okay, things will get ugly, but we'll probably sort through it, right? But if you're emotional about it, and I am too, I look at it and go, oh, man, this looks really awful, right? It just looks really awful. But there's always that we'll probably have a punch up and things will hit the fan, and then we'll all sort of calm down a bit and go, okay, well, all right, we need to work something out here, right? And that's what will happen, right? But it's just unexpected, because for the last 30 years, we've all been making hay while the sun shines, right?
It's an interesting point.
All right. Well, we'll be back next time.
From an undisclosed
for number 2.
location.
Yeah.
And
from the new studio.
Oh, no, that's all right. Sorry. I was just thinking, I talked about a stock, but it was in the premium.
I'll just have to sign up before it's free to listen.
All right. Okay.
Thanks, everyone.
Cheers.
Cheers, folks.